Welcome back. You're still tuned into Trading Hour. Well, South Indian Bank's Q2 net interest income grew by 7% YOY, but the bank's net interest margin declined both on a sequential and on a YOY basis. To discuss the Q2 numbers, the outlook for deposits and slippages, we are now joined by PR Seshadri, the MD of the bank, joining in now. Mr. Seshadri, good morning. Thank you so much for joining in. Well, you've seen a small dip in NIMs this quarter, but this is along with an increase in your credit deposit ratio. Can you give us a sense of how they are trending in the second half? What's the outlook on net interest margins and the CD ratio?
Thank you very much for having me on the show. With respect to net interest margin, we actually didn't see too much of a dip. Basically, what happened was RBI changed the method by which penal interest was actually charged. So up until the last quarter, penal interest was a portion of interest revenue, and this quarter, the reported quarter, it was charged as a penal charge and therefore went into other income. So if you were to add that back, you'd find that there's no material change in net interest margin. With respect to our CD ratio, our stated strategy was to grow our deposits at between 8 and 10%, and that enables us to keep the cost advantage that we currently have on interest costs, and at the same time grow our assets between 10 and 12%. So we were aware of the fact that CD ratios would grow gradually. Now we've hit about approximately 80%. And at this point in time, we are reevaluating, what we should be doing and whether we need to double down and try and get, a little bit more aggressive on the deposit side.
But as of now, your goal is 8 to 10% in terms of deposit growth, but you could look to become a little more aggressive. At least match maybe the asset growth of 10 to 12%?
Yes.
Do you think that's likely? Okay.
That's true, yes.
So within your advances growth and your guidance, in Q2 per se, home loans is done very well for you with a growth of, I think, close to about 40%. Gold loan has seen a growth of close to about 10 to 11%. Can you tell us your expectations segment by segment for FY25 and even the second half of the year? Where is growth momentum being seen?
Majority of the growth will come on the retail side, retail and MSME. MSME continues to stay muted. So our focus is on the secured side. So, gold and housing continues to be areas of, interest. So we think that there we will continue to see the kind of growth that we've seen so far. It will moderate a little. It's hard to be at 45%, growth continually. But having said that, the structure of the balance sheet will alter. Currently, approximately 40% of the balance sheet is corporate. That we think, in the medium term will come down to about a third. So, and the slack would get taken up by retail and MSME.
You spoke about how your focus is, of course, the secured part of the portfolio, and your credit costs, they have remained mostly steady. But there has, of course, been a lot of focus by the RBI on secured lending. I just want to understand how much portion of your portfolio comes in from unsecured lending. Will there be any increase in credit costs in any of the segments going forward?
So unsecured, you get unsecured in two forms, unsecured to the large corporates and unsecured to retail. Unsecured to retail is roughly 5% of our total balance sheet. And that's where the, commentary on, issues that one is seeing is coming to us. That is very, very contained, and we are not looking to grow that very aggressively. On the unsecured to corporate, given the fact that corporates have changed the balance sheet and improved the structure of their balance sheets, we see no particular risk at this point in time. We do have reasonable exposure unsecured to corporates, and we are monitoring that very closely.
Just getting back to that question on CD ratio. So I think currently it's about 78%. By the end of FY25, where do you think that, that number could be? Could we get closer to 75%?
We probably will stay in the same range, 77, 78. If you get too close to 75, then there are significant costs associated with it. So we want to remain very liquid. Our LCR ratios are very comfortable. We are well north of 100%, which is what the RBI wants. But having said that, at the same time, we want to, have CD ratios which are closer to 78, 79, 80%. and not get too close to 75 because of the costs associated therewith.
And one final question, if you could give some color on the asset quality, how slippages are likely to trend, your NPAs in the second half of the year, any trends that you'd like to highlight?
So for the quarter, we came in at about 36 basis points. That is just for the quarter, non-annualized. We think we should remain at these kind of levels. We may, there will be a 5, maybe 10 basis point up or down, but this is the level that we see going forward in the near term. If there is a very significant shift in the environment, that may change, but that we are not seeing at this point in time. So we think that this is roughly the levels that we will be going forward.
All right. Okay. Thank you so much, Mr. Seshadri, for joining in today with the outlook going forward and what happened with Q2 as well. Hope to be speaking to you very soon again. That's the word coming in from South Indian Bank. For now, we'll take your leave on this edition of Trading Hour, but stay tuned. Halftime Report is up next.